If I was to describe the energy, power, chemicals and industrial sectors and what their treasury themes are and what is common, I would first want to talk just quickly about one of the mega trends that affects both industries, and I think that will put it into perspective. The key mega trend for both these sectors is urbanisation. Urbanisation is a truly global trend, and it is affecting the strategies that our clients have. Over the next 20 years, the growth in population for urban centres will reach 60%. So 60% of the world's population will live in cities. So what does that mean? Well, it means our energy, power, chemicals and industrial clients will be building, powering and sustaining cities. So that's key strategies for our clients in both the developed and developing economies. So what does that mean for Treasury? What does it mean for their policies? What does it mean around how they control their business? Well, I think there's several things. It is around control and visibility of their cash. When you look at a global Treasury, it's key, given the expansion and the global nature of their business, they have control and visibility of their cash at all times. I think Treasuries in this industry, in both these industries, have moved towards centralisation at an early stage, and they have centralisation in place. But what is different is often their local cash management is decentralised because of the markets they operate in. If you look at an energy company that has an upstreaming facility in Africa, that business is left alone. If you look at the metals and mining business with exploration facilities in Russia, that business is ring-fenced. If you were to look at the energy and power business in particular, it's a very dollar functional business. So as a result, they've been able to centralise their dollar flows. But what we are seeing is an increasing need for more efficiency around those structures. For the industrial sectors, significant decentralisation in multiple currencies. So where they can centralise in perhaps the G3 currencies, they have. And what they're increasingly looking to do is get more efficiency across the G10 and other currencies in various markets. Back to basics, what does that mean? Well, back to basics is, let's just take a step back and pause around our whole treasury structure and our approach to cash management. And the drivers behind that are that there's been a lot of growth, but we've had 3 years, nearly 4 years now, of some form of crisis. So what are our treasury policies? What are our governance models? What are our end-to-end process? Treasurers are looking at this in quite a lot of detail. Where can they drive as much operational efficiency as possible in the whole end-to-end process? Where can they leverage ERP systems? We've seen the implementation of ERP systems across all our global corporates, regardless of industry, and energy, power and industrials is no exception. But given the decentralised nature, you see multiple installations of the ERP system. There may be episodic acquisitions, which mean a totally different ERP system is introduced. So what we have seen during the post-crisis, and I think the Euro crisis has reinforced this even more, is when we talked about back to basics is how can we consolidate our ERP, not just for cash management, not just for treasury, but across our whole procurement, HR, sourcing process, and drive as much operational efficiency as possible. And I think that's been a key item on the agenda. It's taken up a lot of treasury resource and time, but it's an important consideration. So it's about establishing platforms now for future growth. And I think when you look at the energy and power business, they're achieving that on dollars. They're now looking at other markets that they're going into, perhaps the Russian ruble, perhaps into China with the RMB, and how they then link those currencies into their treasury flows. When it comes to the industrials, they are absolutely now looking at SEPA as part of that. SEPA has been talked about for a very long time, but the countdown has started, and we're now under 2 years before full deployment. And I think why is the back to basics approach very, very relevant again? If there isn't a stable platform for the whole of the treasury and cash management process, the future growth strategies of the corporate will be more difficult to achieve. Secondly, as we've seen post-financial crisis, we've had the euro crisis. So we have, as an industry and as a whole market, been lurching from one crisis to another. So the need to have control visibility of cash at all times for the CFO has become a key consideration. But we've also had a lot of political instability in markets that our clients have gone into. We just have to look at the Arab Spring as a classic case in point. So having stable platforms that allow growth in a controlled way for the corporate, for us, has been an absolute priority and is what I look at from a back-to-basics approach. And I think the final thing that I would add to this, as part of the treasury and cash management flows, has then been the whole financing piece of this. Is, there has been a dislocation in the capital markets, more and more focus on working capital management and how that can be used to help self-fund some of the capex. So again, all back to basic concepts, nothing new, not rocket science, but if the platform is in place, it becomes a really scalable environment for the corporate to operate in. I mean, industry estimates over, if I was to focus on infrastructure, is that $20 trillion over the next 10 years will be invested into infrastructure globally. Where is that going to come from? Public sector, if we look at that and put private sector to one side for the time being. The governments globally are announcing various austerity measures. The UK government is no exception and wants to attract billions of pounds from sovereign wealth funds, from oil-rich states and other pension fund investors to help fund some of this investment. Now, that clearly has to happen. There's essential infrastructure, but some of this will have to be funded in the private sector as well. And where's that going to come from? Project finance, due to some of the credit conditions and market conditions we operate currently, is scarcer. Basel III, which is being introduced and adopted by banks, will also impact returns and will impact the way that banks look at returns. So longer term lending will have a few more hurdles to overcome. So that is leading to more traditional needs of funding, traditional sources. So traditional corporate finance, which are based on cash flows. So a project will have to demonstrate that it has sufficient return, has sufficient cash flows to pay back the lenders. So there's a real competition for capital. And that's a phrase I like to use. And the projects have to be very compelling to attract that. So given that, I think contraction is the right word, but there's still availability of credit. Let's be absolutely clear on that for the right type of project. This will lead to new types of sources, and we're already seeing the export credit agencies, the development banks and the multilateral ECAs provide additional funding outside of traditional sources that we've seen perhaps in the shipping industry or the aviation industry for supporting acquisition of aircraft. We're seeing the ECAs play a role in supplier finance programs, where they provide a wrap around those facilities. We're seeing it also for projects where the capex can have an ECA angle to it. And I think this is important because if you then look at some of the subsectors that we operate in, for example, in industrials, the automotive sector is a very big sector. Perhaps the largest alongside aviation. The automotive sector has some challenges currently, given the markets that globally they operate in, the various credit crises. There's less cash for people to buy new cars. But at the same time, the auto manufacturers need to invest in new research and development, new types of technology, hybrid cars, electric, petrol, diesel, biofuels. That's a lot of research and development, which means a lot of capex. And if there is a shortage of credit to fund that, where's the working capital going to come from? And I think that's where Treasury will play an absolutely key role in helping that. As we look at 2012, what's top of mind for our treasurers? And I think I'd summarise that with a lot of what I've already said. And one of the key words that I consistently see as being top of the list is the word transformation. Treasurers have, over the last 2 to 3 years, put in place new processes, new governance models to comply with regulations and the complex nature of their global business. So they've had to transform their business. They've had to work more closely with procurement, and we see that getting an even more of an important trend and working more closely together because of the impact on working capital. Also leveraging systems and making systems more efficient and delivering best-in-class treasury and more operational efficiency. Again, they are key parts of the transformation agenda. And transformation also looks at cost. Cost from a perspective of how much your whole treasury and cash management structure incurs on a day-to-day basis, as well as the returns that you can get from being very, very efficient. So 2012 for me is leveraging the platform that's been put in place over the last 3 to 4 years, and unfortunately it is a multi-year job, so that job will continue over the next 3 or 4 years to ensure that the Treasury has a very strong impact on the operational efficiency and cash flow, working capital management of the corporation. Now, once that platform is in place, I think Treasury increases its relevance for a corporation. I think you will see, despite some of the markets that we see and some of the challenges, there will be merger and acquisition opportunity. Now, what does that mean for Treasury? Well, it's highly relevant for Treasury. If the platform is in place, our treasurers are telling us they want to be able to bolt on acquisitions so that maximum efficiency can be achieved in a very short period of time. I think gone are the days of making an acquisition and 3 or 4 years later trying to get as much efficiency out of it. Those days are gone. The CFO, CEO are looking to treasurers to have a platform in place that is highly scalable, and as we see M&A acquisition in markets that will help our clients achieve growth, then everyone will look to Treasury for a very scalable solution.